Hello again, everyone. This is Joe Hentges with Beyond the Chart, and in this technical analysis of the stock market video, I'm going to review last week's market action and show why the New York Composite is already signaling 1 to 2 years of significant decline ahead, so stay tuned. All right, let's take a look at the New York Composite on a daily basis. We'll look at it on a monthly, quarterly, and yearly basis here in just a few minutes, but on a daily basis, you can see we sold back down, closed almost on the low, I think fractionally off the low, as almost all the indices did last week. We had 4 days of trading and closed on Friday. And the 21 is still hard down. We're below the 55, below the 233. Everything's still lined up down here. The rallies just can't seem to hold. You know, we get some significant rallies. We get 3-day rallies, 2-day sell-off. You know, 3 to 4 day rallies, and then you sell off. And it was interesting. I told my insiders last week we had a very low reading on the put-to-call ratio on the 29th, and it was the exact same reading we got on the 16th of December. And both days now were followed by 2 very hard, selling days afterwards. Now, these 2 days weren't nearly as much as this one, but we don't know if this one's done yet. So it's going to be real interesting to see if it comes down, breaks this trend line. We break this trend line, take out this low, we're definitely going to challenge these lows. It's what I'm expecting. This picture is a lot more negative than the S&P 500. And let's just take a look at the Russell 2000. The Russell 2000 is in a similar breakdown type picture. Definitely weaker than the S&P 500 and even the Dow. It closed down 13.75 for the week, and again, almost on its lows for the week. Let's take a look at the weekly charts. On the New York Composite on a weekly basis, we've talked about this before. It's broken this very long-term trend line. We're in this, we got this reversal bar this week, and again, closing on the low for the week. So not only did Thursday close on the low for the day, but literally on the low for the week. So I am looking for some continuation, but that's critical. I mean, that's the key thing. You have to have some continuation in here to confirm that this is a reversal type bar. Come on down, take out the lows of the previous week or two. Russell 2000, the same type of thing. Blow that up a little bit in a reversal bar, and actually a little more negative than some of the others because we closed what looks like at least at the midpoint of the previous week, if not slightly below it. And usually I like to see that, if you can close down in the lower half, that's a little more negative picture there on the bars. The wave count I've got, I do believe that, the market, the S&P 500 peaked in May. This one's peaking in June. Yes, I do believe we're in a wave count heading down. I haven't spent a lot of time talking about the Russell 2000. I don't have it laid out on the New York. I've got it detailed for my insider members on the S&P 500 and on the Dow Industrials. But yes, I believe we're working a wave count down. Let's go back, and I want to take a look at the McClellan oscillator, which I've got on the New York Composite. And, we, with Thursday's price action, Wednesday was a little tentative, but with Thursday's price action, looks like we've got a little M top in here that seems to be confirmed. When we get a close below the middle of that M action, it looks like it usually confirms. That doesn't mean we can't get a little spike rally, that we couldn't get one even on Monday, a little fish hook type of thing. You see this M top over here? Markets have a tendency to form little M tops and W bottoms, and that's what I think we're getting. We were very overbought here. This was extremely overbought. Of course, down here we were extremely oversold. So right now we're in this slightly overbought territory, and definitely have got room to come on down. Let's take a look at oil on a weekly basis. Oil was down for the week, and at least USO was, and I'm pretty sure oil was too. I know it had gotten pretty low and it bounced a little bit, but we've got a little doji bar in here. So again, this was a potential reversal. We are seeing some divergence on the indicators. So we could be getting a bounce, but we just didn't get the follow through here. So it's going to need to take out either the high or low of this prior week over here, the week ending of December 25th. Gold just can't seem to get a head of steam to pop to the high side. I wouldn't be surprised, based on the way it's acting, wouldn't be surprised to see it throw over below this lower end of this diagonal. This is an ending diagonal pattern to me. We got these 3 wave patterns of 1, 2, 3, 4, 5 in here. This one's a little less clear. We may not be done. We may be creeping back down into here. This is a support zone. So we're watching this pretty closely. And when I say it every time look on the daily chart, every time we get a big rally and you think it's going to run, then it just sells back off. You know, nice 2-day pop in here, sells back off. You think it's going to go, and then it just comes back the other way. So they use it as a selling opportunity instead of, so the bears keep winning in here, and we're going to need it to turn it the other way around. All right, now I want to take a look at the longer term picture of the New York Composite. Okay, so here you've got the New York Composite on a monthly, on a quarterly, on a yearly basis. So let's start off here with the monthly. You can see the divergence on the RSI. This is an 8-bar RSI that I use. So just to keep it simple, I'm just going to focus on the RSI, clearly signaling divergence. This has broken the trend line. We've gotten a moving average cross in here. And, you know, these moving averages on a monthly basis don't cross very often. As you can see, we had a little bit of waffling back here in 2011 into early 2012, but they just don't cross very often, and when they do, they usually signal something's coming. Now, that's not the big signal that I was talking about in the preview, so let's look at that. You know, we'll keep that up for now. We've had 1, 2, 3, 4, 5 months in a row below the 10-week or 10-month moving average in here. On the quarterly basis, we're also getting some closes, 2 consecutive closes. This did close slightly below the 10. Now, we don't have a cross, but for the first time, we're getting closes like we did back here in the first and second quarter of 2008. Now, is that going to lead to something like that? Who knows? Right now, I mean, we're showing divergence on the RSI. We're showing the closes below the 10. You know, this has to happen before anything else is going to happen. So right now we're getting kind of step 1 put into place. Now look at the yearly chart. Look at the divergence that's shown on the yearly chart with this, the 2000 high, the 2007 high, into the 2014-15 high in here. Now, here's the point I want to make on this. Let me blow this up a little bit. And I can zoom out of this all the way. Now, this is all the bars I have on the New York Composite, unfortunately, back to 1980. I don't know when they actually started keeping the record on this. But here is the big, in my mind, the final big cycle wave 5 of the Elliott wave count for the big bull market we've been in started in 1982. And we're finishing that move right now. And in May, I believe it already finished. I believe it finished in May of last year. So the thing to notice, these are yearly bars. Notice how it never takes out the prior year low. It never takes out the prior year low until it's ready to correct. And what is this year? 2001. It breaks the 2000 low. It did not do it here. This low is 6092.27, 6094.91. Did not take out the low of the 1999 low in 2000. It did it in 2001, and then we sell off into 2002 and eventually then reverse. And then, so now the move of 2003 into 2007, it never breaks the prior low until the 2008 yearly bar breaks it and, of course, smashes on down. So now we get the reverse again, bottom, very similar to here. We got it in 2009. We rally up. We never take out the prior year low until 2015. We broke the prior year low. So to me, we've signaled that we've got a weakness in here, and I would not be surprised. The New York Composite has been shown itself to be leading and weaker than the most of the rest of the key ones. And it's broader than the S&P 500. It's broader than the Dow for sure. So right now, I think this is an interesting sign. And by the way, on the S&P 500, the prior year low, the S&P 500 hasn't done this yet, but the prior year low is the August low of 1867, I believe, is the number. So it's the August low. That's the low for 2015. Get my years confused. All right, so that's the picture that we're dealing with right now, and we'll see what shakes out. But we are getting divergence, and we're getting a prior year low break. So I think we're in for some interesting times. All right, that's it for this week. If you like the video, please hit the like button below, and definitely come on over to the website and check out the membership over there. It's been Joe for Beyond the Chart. Have a great weekend.